Geiger Capital says Apple Q1 revenue is $124.3 billion. 2022 Q1 revenue was $123.9 billion. 0.3% revenue growth over 3 years. We've had 15% inflation since then. iPhone sales are negative year over year. This is not a growth company. G. Stockus says, since 2023, Apple stock is up 98%, and price over sales up 80%. Little growth, lots of multiple expansion. Blake says, if you think fundamentals matter in the stock market, they don't. Apple hasn't had growth in nearly 5 years. The stock is almost up 150% in that time. Martin Pelletier says, if you can't increase sales, then financial engineer your growth. Good luck, investors, at a 10x sales multiple and 40x earnings. No wonder Warren sold. Welcome to The Quality Investor. I don't disagree with any of the sentiments conveyed in these tweets. I don't view Apple as a growth business. There is nothing compelling in its product lineup that warrants excitement. The Vision Pro was a dud. This is a problem for many investors. At its heart, Apple is a product-oriented business. Steve Jobs once said, and the companies forget what it means to make great products. Sort of the product sensibility and the product genius that brought them to that monopolistic position gets rotted out by people running these companies who have no conception of a good product versus a bad product. Well, Apple has not released a truly transformative product since the iPhone. The iPad and Apple Watch are great, but I wouldn't label them as transformative. A strong argument can be made that Apple's days of earth-shattering innovation passed with the great Steve Jobs passing. Side note, I highly recommend the Steve Jobs biography by Walter Isaacson. Remarkable insight into true genius. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. The iPhone was released in the summer of 2007, and it was a massive event. It completely revolutionized how the world interacted and could be seen as the seminal moment when the world truly entered the digital age. It created the cottage industry of apps. Some believe companies like Uber and other app-only businesses only exist because of the foundation laid by the iPhone. It completely disrupted industries like in-car GPS services and pocket cameras. In 2010, 109 million pocket cameras were sold. By 2018, it was down to 9 million. The iPhone, and by extension other smartphones, have become indispensable to our daily lives. Yet since then, Apple has not done anything remotely close to what the iPhone did. From the iPhone's release in 2007, sales shot up each year until 2015. But since 2015, sales have remained pretty stable, hovering in the 200 million plus units sold range each year. The iPhone became Apple's largest segment, accounting for 56% of revenue in Q1 of fiscal year 2025. But like I said, sales have been fairly stagnant. Apple's 10-year revenue CAGR is 7.9%. Its 3-year revenue CAGR, a paltry 2.25%. These are not revenue growth numbers of a business on a high growth track. Microsoft has a 3-year revenue CAGR of 13.4%. Meta is at 16.2%. Google is at 19%. But there is something curious about this. While Apple's growth has demonstrably stagnated, their share price tells a different story. Over the last 10 years, Apple has returned 23.2% annually. Its return over the last year is 26.3%. This growth in share price has investors perplexed. If you go on X, people routinely point out their stagnant revenue, high multiple, and poor product roadmap, all of which are true, and lambast the stock as overpriced. And actually, I tend to agree. I believe Apple is at an extreme premium right now. But I want to offer an alternative explanation of why a company with lackluster revenue growth continues to outpace the market as a whole. And despite its year-to-date pullback in the market, it is still the most valuable business in the world at over a $3.5 trillion market cap. My thesis is simple. Over the long term, the market values certain fundamentals above all else, and the share price tends to move in lockstep with one of these fundamentals. I believe the market values expanding margins, high return on capital, and growing free cash flow. And in each of these metrics, Apple is still growing. It is simple, really. Expanding margins facilitate higher profits, and higher profits facilitate a higher return on capital invested in the business. And if a business can generate higher profits without the need to materially increase reinvestment in the business, increasing CapEx, that turns into higher free cash flow, or what is left to the owners, or investors in this case. Apple excels at this. But it seems like the only focus for investors on X is revenue growth, or lack thereof. Has Apple made the transformation from growth business to stalwart? Maybe. However, stalwarts can still provide above average returns. Walmart has returned 74% on a one-year basis and over 13% annually in the last 10 years. Home Depot has a 10-year return of 14.7% annually, and McDonald's is at 12% annually. The flip side to this is a business like Coca-Cola. This stalwart has underperformed the market at 4.4% growth in the last 10 years annually, and Procter & Gamble only at 7%. Based on Apple's PE of 37.5, investors still believe there is value to be had. We shall see. But this video is about why Apple has continued to produce high returns while top-line growth has stagnated. Bottom-line growth, or earnings per share, has also stagnated. Despite enormous share buybacks Apple has done, their EPS growth the last 5 years is only 2.7% annually. By all appearances, Apple should not be getting these outsized returns. I believe this misses the importance of what long-term share price increases actually are. And note, I said long-term share price increase. Over time, the market tends to reflect the true value of a business. It is, in effect, measuring value creation. In investing, the principle of value creation is this: anything that increases cash flow increases value. And Apple generates more free cash flow than any other business in the entire world. They generated $9.3 billion in free cash flow on a trailing 12 basis. By comparison, Microsoft is at number 2 at $70 billion, and Nvidia at number 3 is at $56.5 billion. And ultimately, that's what we are valuing. How much cash can a business generate into the future, and then we discount it back to today's value. Increase cash, increase value. While it is true revenue growth overall has been slow for Apple, they have one segment that is growing like a growth business. Not only is that revenue growing, it is doing something vitally important to value creation: expanding margins. Apple's service segment is quietly driving value creation for Apple. It is driven by subscription revenue, things like Apple Pay, Apple TV Plus, and Apple Music, and now has over 1 billion subscribers. It is a high margin business because it is mostly software based, so a new subscriber doesn't add incrementally to the cost of the service provided. This high operating leverage means an already high margin business, over 74% gross margin in Q1 of fiscal year 2025, will only expand margins as new subscribers are added. Services represent over 26% of Apple's current revenue. It is projected to grow twice as fast as the rest of Apple at about 10% over the next 10 years. This means that services could represent over 34% of revenue, assuming the same segment mix, by 2034. And with margins expanding, possibly 80% gross margin for services by 2034, this could push Apple's overall operating margin from 31.5% to nearly 40%. It is the services segment that will ultimately drive profitability for Apple. And it was services that had already driven Apple's profits the last few years. Let's look at some charts for Apple since fiscal year of 2020. These are Apple's profitability charts. And you can see something very obvious starting around fiscal year 2020. Gross margin was at 38% in fiscal year 2020. Since then, it has grown to 46.5% on a trailing 12 basis. Operating margin down to 24% in fiscal year 2020 and has since grown to 31.76%. This margin expansion demonstrates the power of services segment for Apple, an incredibly high margin business that is the catalyst for the margin expansion we have been seeing at Apple over the last 4 or 5 years or so, and has allowed Apple to return just over 24% annually during that time. The 5-year CAGR for the services segment is at 15.75%. iPhone revenue, by comparison, has a 5-year CAGR of 7.16%. So services is growing twice as fast as iPhone growth. And services is what's going to drive future revenue growth for Apple. Back in fiscal year 2020, the services segment accounted for just under 20% of Apple's total revenue, and today has grown to roughly 25% of Apple's revenue. If the current growth projections hold, which I'm projecting lower growth going forward than what Apple has seen in services in the last 5 years, about 10% over the next 10 years compared to 15% the last 5 years. If those current projections hold, the services segment will make up over 1/3 of Apple's total revenue. But on top of that, like I said earlier, with the operating leverage that the services segment has, it's going to expand margins even further. Operating margin could expand to nearly 40%, probably about 38 to 40% in the next 10 years. And that's what's helped driving up this chart right here, return on invested capital. Now, Apple's always had a very high ROIC. You can see the ROIC in fiscal year 2020 is at 30.5%. ROCE, return on capital employed, is at 36.9%. That has since grown to an ROIC of 47.7% on a trailing 12 basis and an ROCE of over 50%. Apple is generating a return of 48 cents on every single dollar it's invested into its core operations. And very generally speaking, return on invested capital is a very good proxy of the return you can expect in the market going forward. It's obviously not one-to-one. Higher ROIC businesses will generate higher returns over time. This is the compounding effect. In effect, this is operating leverage in action. Charlie Munger once said, "Over the long term, it is hard for a stock to earn a much better return than the business that underlies it earns. If a business earns 18% on capital over 20 or 30 years, even if you pay an expensive-looking price, you'll end up with one hell of a result." Well, look at Apple's ROIC. Very simply, ROIC is the amount of net operating profit after taxes, or NOPAT, over invested capital. Invested capital is all capital invested in the core operations, which is very simply working capital and property, plant, and equipment. For Apple, this excludes their considerable investment holdings, which make up 1/3 of their $344 billion in total assets. With NOPAT of nearly $100 billion over invested capital of roughly $230 billion, this translates into a huge ROIC at 47.7% on a trailing 12 basis. I mentioned that margin expansion aids in value creation. This is because an expanding margin means a business makes incrementally more profit on every dollar of revenue. If operating margin is 30% one year and expands to 35% the next, the business earned an additional 5 cents on every dollar of revenue. That, in turn, increases ROIC, or how much a business can generate based on what is invested into core operations. But to continue earning a high ROIC, A business needs to reinvest a portion of its profit each year back into the business to continue growth, specifically growth in NOPAT. I've talked before about how on the Quality Investor, we seek capital light businesses. Capital light means a business only needs to reinvest a very small portion of NOPAT back into the business to continue to generate growth. There is a relationship between ROIC, reinvestment, and growth. First off, I'm defining the reinvestment rate simply as capital expenditure over NOPAT. From there, we can derive an implied growth rate, defined as reinvestment rate multiplied by ROIC. What this all means is in order to grow by X%, a business needs to reinvest at Y%. And that reinvestment percentage is determined by ROIC. Basically, the higher a business ROIC or return, the less capital a business has to reinvest to grow at a certain percent. Let's say two businesses want to grow 5% each year. If business A has an ROIC of 20%, they'll need to reinvest 25% of their NOPAT back into the business. 20% times 25% equals 5%. If business B has an ROIC of only 10%, then they'll need to reinvest 50% of their NOPAT. 10% multiplied by 50% equals 5%. Higher ROIC means less reinvestment to grow. Less investment, in other words, less capital expenditure, means more free cash flow left to investors. And that is what drives value, free cash flow growth. There is a strong correlation between free cash flow growth and share price appreciation. Let me demonstrate this relationship. This is a visual representation of that relationship. This first chart here is annual ROIC and investment rate. Apple's ROIC here charted in orange over time, 41.7 on a trailing 12 basis. The investment rate in blue here is capital expenditure over net operating profit after taxes. Just looking at core earnings of a business, operating earnings of a business, and then subtracting out the taxes that they pay. And this is what I mean by capital light. A very low percentage of NOPAT is going to fund capital expenditure. And a sign of business efficiency is this investment rate declining over time. A business is becoming more efficient in its operations, which in turn helps to drive higher ROIC. And then as that business matures, which Apple's probably crossed into the mature category now, it can maintain its current operations with very little investment back into the business. And that's what this next chart is demonstrating over here. Year over year NOPAT percentage versus implied growth. Implied growth is simply investment rate multiplied by the ROIC. And you can see the implied growth here, the blue line, generally hovering around 6% over time. So on a trailing 12 basis, Apple has a 4.96% implied growth rate. Now, obviously, the actual growth rate is very different, and it ping-pongs over time because you're never going to have a truly one-to-one relationship there. But Apple's operating income has grown about 8.9% annually over the last 10 years. In the last 3 years, it's grown 4% annually. So the real growth's not wildly out of line with this implied growth. But at the end of the day, what we care about most is free cash flow. How much cash is coming into the pockets of investors? And as margins expand, meaning you're getting higher profit for every single dollar of revenue, that's only going to expand free cash flow, especially if the rate of investment continually comes down, which it has in Apple's case. But here you can see that relationship between free cash flow growth and share price growth. They grow virtually in lockstep with one another. I posited that share price appreciation follows free cash flow appreciation. And that's exactly what this relationship is doing. And I'll show you a few other businesses to demonstrate this free cash flow and share price relationship. Here's Google. Free cash flow growing over time, share price falling right along with it. Free cash flow dips a little bit in fiscal year 2022, so does the share price. It starts climbing back up, so does the share price. Amazon's a very good example of that because Amazon has massive volatility in their free cash flow. And you can see the same relationship here holds. As free cash flow grows or dips for Amazon, so does the share price. It tracks right along with it. This is a crucially important relationship, and to me, it's ultimately what drives long-term growth in the market over time. Businesses growing free cash flow are going to be the winners in the market and winners in your portfolio. Finally, I want to show what I believe Apple's current price target is. I said at the outset that I do believe that Apple is trading at a premium right now. Despite my demonstration about why Apple's share price has grown over the last few years, I do believe it is a bit high, but it's not wildly out of line of anything. So Apple closed today at $228.01 and has a PE ratio of 36.2. You can see here it's well above its 5 and 10-year average. The argument could be made that that multiple expansion is because Apple is converting more and more into a services type business, high margin business that is more focused on growth. They have a forward PE right now of 30.9, also above their 5 and 10-year average. My DCF valuation has Apple at a bear price of $182, a base price of $222.77, and a bull case price of $273.51. And for context, my bear case assumes about 6% free cash flow growth over the next 10 years. My base case assumes 8.5% free cash flow growth, and the bull case is assuming 11% free cash flow growth over the next 10 years. So nothing crazy in the growth department there. Its exit multiple is at $225.54, and that gives us a valuation average on the bear of $197.24, $223.74 on the base case, $256.72 on the bull case. Now, Apple does pay a dividend. However, I'm not including the dividend discount because their dividend growth is practically nothing. Apple rewards its shareholders via share buybacks rather than the dividend. And the dividend discount could be considered an outlier, in fact, and I think not a true reflection of what investors can expect in return over time. So you can see the upside and downside here for each of these cases, meaning on the bull case, there's still over 12.5% upside. That's assuming Apple hits fairly reasonable growth numbers. By the way, that assumes revenue growth of 7.3% over the next 10 years. I don't think that's out of the ordinary for Apple. They are certainly slowing growth down, but I certainly don't think 7.3%, and that's my bull revenue growth number. I don't think 7.3% revenue growth is unreasonable on a 10-year basis. So with no margin of safety, that's a buy price of $225.36. That's right in line with the current share price. Obviously, we have a bit of a pullback in the market due to some ongoing macroeconomic issues, but again, it's not wildly out of line. At a 10% margin of safety, that's a buy price of $202.82. That's a forward PE of 27.5, slightly above its 5-year average. With a 20% margin of safety, it's $180.29. Now, Apple, to me, you can get away with a 10% margin of safety. In this instance, though, I would want to see it come down a little bit more than $200, probably around that 20% margin of safety range at about $180 to $185 if I were to buy more. But I do believe there's a lot of value still to be had with Apple. I agree with many people that their massive growth days are over, and if Apple introduced a new product that was wildly blew the market away, I think we definitely could get back to massive growth. However, I don't see that happening. But so long as Apple keeps expanding its margins, focusing on that services segment, and continues its managerial discipline when it comes to how it invests its money back into the business, remember reflected in the ROIC, I think Apple will continue to return very well for investors and even at above market returns. So let me know what you think down in the comments. Is Apple done as an investment? Are they wildly overpriced? Or do you think there are some good days ahead despite a much slower growth trajectory? Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.